Stocks rose on Friday today, driven by gains in technology, as the artificial intelligence trade seeks to recover from the volatility of recent weeks. A cautious outlook for Nike has raised concerns that tariffs may continue to challenge the outside of tech sectors in 2026. Let's go to Geoff Phipps, trading strategist, portfolio manager at PICTON Investments. Thanks for joining us today.
Thanks for having me, Marilla.
So the change in sentiment, is this coming from the Micron results?
I think what we've been going through is a bit of a changing in the narrative with respect to AI CapEx. And this has related to a change in leadership internally. I would also make the case that what we've seen in terms of the recovery over the last several months, economically and in markets, it has been accompanied by some very accommodative sets of both fiscal and monetary policy. And that has also helped drive some of this rotation that we're continuing to see.
So it's rotation, but really the past couple of days, meaning the last 2 days, we've seen things perk up again. Is this the Santa Claus rally many had expected?
To some extent, I think it is, yes. Overall, we did have a pretty long period of that rotation playing out. Overall, the view is for us going into 2026 is that the backdrop of decent macro fundamentals and a fairly sort of, if you want to call it an orderly deflating of some of the more speculative parts of the AI bubble, that can continue. And macro conditions are aligned with that continuing.
All right. You describe AI as a double-edged driver. Can you explain that?
Absolutely. There are different aspects to it. So on one hand, we've had this recovery, particularly in the United States. This has been called sort of a K-shaped recovery or a very not normal sort of labor cycle. So to some extent, the lower end consumer has not necessarily participated economically in the recovery and growth in the U.S. economy. AI has been one part of that. I think tariff probably has something to do with that as well. But certainly we are seeing, I think, some impacts of AI on hiring as well as where investment goes.
Okay, let's talk about the new Fed chair expected in May and likely to favor lower rates. That's the way it looks right now. How do you think that'll work out into the economy and the outlook for 2026?
I think that you're right. We are likely to have a Fed chair that is sympathetic, to put it lightly, to the White House views in terms of monetary policy. We know that because we are in this period right now where globally, to a large extent, where fiscal policy has taken on a new role of dominance, that the tools of monetary policymakers like the Fed, like the Bank of Canada, they aren't that well suited to curb things like embedded inflation from things like tariffs, from things like fiscal impulse. So I think the view is we are probably going to see a couple more cuts from the Fed. They probably skew to later in the year, and it's more likely than not that we do get a pause in January.
Okay, we had retail spending in Canada sort of drop for October. It looks like there might be a bounce back in November. We're not really sure yet. What do you expect as far as bank cuts next year from the Bank of Canada? So
the forward market has really priced the Bank of Canada pausing. There's even a little bit of pricing towards a hike next year. You mentioned some recent macro data in Canada. Headline data, including jobs data, has been a little bit better over the short term. Again, the internals are a little more mixed. I would say that this is probably, this and the focus on inflation is causing some pause in terms of how the Bank of Canada is thinking about their cutting cycle. Again, I do think there is a little more risk in Canada to some of those fiscal measures not providing the rubber hitting the road due to some of the lack of productivity, growth, and capital formation that we've seen in Canada that appears somewhat structural.
Okay, let's talk about sectors that you think will perform next year. What are you looking at?
Well, this rotation and broadening out trade, which is not without risk. I do think 2026 is going to be the year when the market determines which domestic market fiscal programs are actually going to provide a return on investment. But assuming that we don't have any problems in the bond market or credit, I think the more cyclical parts of the economy can continue to perform well within the market. That includes consumer discretionary, parts of industrials and financials. But I'd caution that some nuance is required. For instance, large cap banks, both in Canada and the US, they are pricing very high multiples. They are pricing an early cycle environment. So a lot has to sort of go right for those to grow into their multiples. Having said that, there are a lot of areas within those sectors I mentioned that have been overlooked for a number of years at this point.
Okay, so equities, I think most do expect to do well next year. What about bonds?
We are a little cautious on bonds. I think I did mention to you that that 2026 may well be the year that markets start dissecting the differences between a lot of the domestic economy's fiscal programs that, for now, have sort of been the tide that has risen all ships. When we look at historical periods, when the market starts applying a little more of a skeptical eye toward deficit expansion relative to the return on investment of that deficit expansion, looking at the long end of bond markets is often a pretty important thing to do. So again, we do have a lot of credit supply hitting the market in the United States next year. We do have a sort of an uncertain government funding mechanism for next year in the United States, including Besson potentially trying to just rely on the bill market like Yellen did. So again, we are a little bit more cautious on the bond market. Things still can go right. But our general view with respect to bonds is that we cannot expect in a portfolio of bonds to be a useful diversifier the way they have over many decades.
Interesting. Okay, Geoff, I've got to leave it there. I'm out of time, but thanks for your time.
Thank you so much.